Hello, friends. My name is Chris Lee, and I am a CPA who works with modern entrepreneurs to help them save on lifetime taxes. And so I'm glad to be with you today. And today we are going to talk about a topic that's one of the biggest opportunities you'll ever have to save lifetime taxes. And this is particularly oriented to entrepreneurs who think they might, ever consider selling their business and have that idea from the start. And this could really be worth saving you, millions of dollars in lifetime taxes. And so today we're going to talk about qualified small business stocks. Sometimes this is referred to as QSBS. Sometimes you'll hear it referred to as Section 1202 stock, which is, just the code section for which that allows this special tax treatment. But yeah, this is a topic that has kind of gotten lost over the years. It's been around since the 90s, but a lot of people have usually favored partnership structures and pass-through structures just because of avoiding what people know to be double layers of tax. But today we're going to talk about why and how sometimes the C corporation may be a better option for you if you think you might ever want to exit your business. And C corporations are essential for obtaining, the qualified small business stock. And with recent legislation under the One Big Beautiful Bill Act, we're seeing a lot more conversation around qualified small business stock. And frankly, there's a lot of work I've already been doing for a couple of years, and now people are finally hearing about it, interested, and trying to, get some more information. And so that's what we're going to do today, is give you kind of the foundation. So let's start from the top and, understand what QSBS is. QSBS, also known as qualified small business stock, is a special kind of stock issued by a C corporation that meets certain requirements. And what these requirements typically are is that we'll get into that in a second. But the goal of this, though, is the special stock that's issued by a C corporation, if held for long enough, if it is later sold, if you were to exit your business, you could exclude up to 100% of the capital gains triggered from that transaction from federal income tax. This is not a deduction. It's not a deferral of the income. It's a complete exclusion of the gain that gets triggered from the transaction. And that's huge, right? Say you sell your business, you have a $10 million gain from the transaction, and all of that goes untaxed at the federal level. And to be honest, many states also conform to this provision. So that's also a state level tax avoided. So for modern founders, especially those that are scaling startups that have the idea that they may ever want to sell their business, this is one of the last remaining ways to legally and permanently eliminate millions of dollars in taxes, in a future event. Because really, scaling startups have the potential to be that unicorn and have a big boom. And, QSBS is that opportunity to save taxes if your goal is to exit in the future. Now, the thing about this special C Corp stock is that not every C corporation is going to qualify. So first, it must be a domestic C corporation, so incorporated in the United States, or organized. You can also do this with an LLC that elects to be treated as a corporation as well. But it must be organized under the laws of the United States, so under a specific state, or you could use a DC jurisdiction. That is also as a jurisdiction that would be appropriate. But at least 80% of the assets must be used in an active trader business. So active trader business is usually going to be exclude those that are service-based businesses. So attorneys, accountants, lawyers, those sorts of service-based industries are excluded. This is akin to saying, how we have the qualified business income deduction. All of those fields that are functionally a specified service trader business are disallowed from, organizing a C corporation and claiming QSBS benefits. So those are the excluded industries. What are the included industries? It's really those that are tech-oriented, manufacturing-oriented, those selling products, those in retail businesses, those sorts of things. So not providing services, providing technology or goods to end customers. So that's it must be a domestic C corporation. It must use 80% of its assets in an active trade or business that is usually kind of in a tech, manufacturing, product, or retail service business. And this must be newly issued stock, so you can't have acquired it from another person, like buying into the business. You must, acquire that stock in an exchange between the corporation and shareholder. And upon organization, the value of the C corporation must be 75 million or less. So this is actually a new rule under the One Big Beautiful Bill that passed in July of 2025. Old rules had that, fair market value, or rather the adjusted basis of the assets in the business, at a $50 million limit, and now it's at a $75 million limit. So what that meant was, or what this means is that all the capital that's coming into the business at startup, or when you issue newly issued shares, if the value is 75 million, above that 75 million threshold, it doesn't qualify as QSBS, or qualified small business stock. If it's under that threshold, the newly issued shares qualify as that stock. And if you meet all the other requirements of, holding it at least 3 years, usually we prefer, we can get some benefits on the sale. So what ends up happening is that, like I said, we're usually looking at, does the stock qualify? Does the stock potentially qualify? Second, who owns the stock? And then how long did you hold the stock? So we've already talked about that it must be newly issued stock. And another important characteristic is that the stock must be held by a natural person or a trust. You can't use other C corporations to claim the 1202 benefit. It must either be ultimately landing on a personal income tax return or a trust tax return. You can use flow-through entities to structure some of these items, but that's a little bit advanced, and we'll talk about that in a later course, or not course, but rather a later conversation about this. But it must be newly issued stock from a C corporation, ultimately owned either directly or indirectly by a natural person or a trust, and it must meet that 75 million threshold. Now, the goal to be able to also qualify for this gain exclusion, you must have held the stock for long enough. So previously, you had to hold it for 5 years to be able to achieve the gain exclusion. So you receive the stock and you hold it for 5 years. Any exits after the 5 years for qualified stock can achieve a gain exclusion up to, it used to be 10 million or 10x your adjusted basis in the stock. So if you put cash into the business, in exchange for newly issued stock, 10x the amount you put in. So if you put, and this is the greater of the two. So say you put $50,000 to form a C corporation in. When you exit, and presumably it gets all the qualified small business stock benefits, that $50,000 times 10 would be $500,000, or you could have taken the greater or $10 million exclusion. So it's the greater of 10x your basis or the legislatively permitted max. So that's functionally what we get. So if you were to put 10 million in to form a domestic C corporation, and then your exit was 100 million gain, you could exclude the 100 millions of gain, up to 100 million of gain, because it's 10x your basis. And so that's functionally what we're looking at now for stock that is issued that otherwise qualifies. We can get a $15 million gain exclusion just as a freebie under the new legislation. Now, we also, when we're thinking of the holding periods, we used to have to hold it for at least 5 years to get the gain exclusion. But now for stock issued after the July 4th, 2025 date, if we hold for 3 years, we can exclude up to 50% of our gain. If we hold for 4 years, we can exclude up to 75% of our gain. And once we hit that 5-year mark, we can do that 100% gain exclusion with all the other, items that we think about with the certain limitations that exist. And so even if you exit earlier than 5 years now, say year 3 or year 4, you can still keep a significant portions of the gain shielded from tax. And so that's really the big thing that we're seeing with the One Big Beautiful Bill. The July legislation is the fact that we've now got these 3-year and 4-year buckets that we can use to achieve some gain exclusion. Also, the big benefit too is that we've got a larger asset cap. So upon formation, so that 75 million cap gives us a greater access to use either some private equity funds or VC funds or what have you, without blowing the opportunity of the QSBS. Because if you're going to have significant checks at startup from institutional sort of investors, when I say institution, I don't mean bank, but those that are just professional investors that are looking for those unicorns. Historically, we were always being conscientious of that $15 million cap, but now we've got an extra 25 million, bringing us to that $75 million cap. So you can accept larger checks without having issues with triggering ineligibility for qualified small business stock. The additional thing is that the 75 million with the asset cap is now indexed for inflation after I believe it's 2027. So this lets us, use inflation to be the index for on top of the 75 million. So that 75 million threshold will grow over time. So putting this all into perspective, let's say, again, you invest that $50,000 into a qualified C Corp. 5 years later, you sell your shares for $500,000. Your gain is the $500,000 you got out of it minus the $50,000 you put in. That's a $450,000 gain. You've met the otherwise required elements of QSBS under 1202. That $450,000 of gain is tax-free. So we still have to report it on the return, but it's tax-free. The good thing is too is so maybe you start up a business with a little bit of sweat equity. You don't put any real capital into it. You just put your time, energy, and effort. You build it up over several years, and say you sell it for 15 million, and you started your business after, say August 2025. You start your business. You build it up over several years, and you actually sell it for $15 million. Several years after the 5-year mark, you could exclude 15 million of that transaction tax-free. 15 million straight off the bat. So the legislation just gives you 15 million right off the top. And this is not a loophole. It's just a policy meant to encourage innovation and small business investment. Again, this is not for service-based businesses. It's really looking at tech, manufacturing, product, or retail operations. Sometimes you might see that in other elements of the distribution and supply chain, businesses that are functionally integrated in there. Those can be some other elements beyond just manufacturing, but they're not, service-based business in the sense of providing professional services with, say a professional license or something like that. So when we think of this, what's going to happen and what do, entrepreneurs need to think about? So one, if you're starting a new business, you need a plan to scale. You need to consider a C corporation structure and think about what's your plan with this business. Is this going to be, grow it, own, and operate it indefinitely, or is your plan to grow and sell? If your plan is to grow and sell, I would encourage the C corporation structure as a consideration. It might not be the right answer, but it's something we would want to think about. So second, you'll need to track stock issuance dates, because this only applies to original issuances. It's not secondary purchases. Those don't qualify. Also, if the entity has any history of being an S corporation, that usually is going to disqualify it. So you can't have an S corporation, revoke the S election, and go back to a C corporation and achieve this result. There are ways to kind of fix that problem, but they're much more complicated than someone might realize, and they take a lot of effort. And so fixing that is not ideal, but it can be done under certain circumstances. So that's a totally facts and specific and separate conversation. You have to be mindful of what is your company going to do. Again, if it's service-based or reputation-based fields like lawyers, architecture, engineering, doctors, accountants, performing arts, those sorts of things, this isn't a code section you need to be thinking about that's going to benefit you, because it's not. You really want to be looking at operating businesses. And then, like I said earlier, most states do conform to QSBS rules. However, there are some states that don't conform. And so what you'll see there is you'll want to consider what are the state impacts on selling QSBS stock and what is my state of residency. So say you're growing your business and you're thinking you might sell in a couple of years, you maybe would choose to relocate, change your state of residency to a state that does qualify for QSBS or is an otherwise tax-free state, to also avoid state income taxes on that sale. Now, what I will say is that even if you do relocate, depending, certain facts and circumstances could trigger that gain to still be connected to another state. So that also is going to be fairly facts and circumstances specific. So that's like a very individual consult as to like how do we deal with state tax consequences on a future exit. So this is where you work with a tax professional that has experience with QSBS and also has kind of experience with multi-state tax and in planning taxes across multiple jurisdictions. And again, this, when you're trying to change your state of residency, that really is a multi-year process. And so it's something you want to talk about on the earlier side of things. You can't just wait until a transaction opportunity comes up. You've got to be thinking about this for several years in advance, just because changing your residency is a multi-year process. And I say your residency to mean your state of residency. It can also be, if you're trying to change your state of your residency as like a US resident or a non-US resident, that also can be a multi-year process depending. But like I said, this is mostly, we really need to think about what is your business going to do? How much capital is it going to take in? When was the stock received? And, really managing, the timelines of everything, and really the documentation that is really super important as well, to make sure that if the transaction was audited where you did claim QSBS, you've got to document all along the way why and how your stock qualified for the QSBS treatment on that exit. So for founders or early employees that might be receiving stock options in a startup, it is one of the most strategic tools you can use for long-term wealth creation. And there are strategies to even amplify it that we can talk about in other videos. And like, it is really a real-world reward for building something that contributes to the economic growth. And that's why Congress gives us this way to, have a tax-free exit on building something big and desirable, right? And so if you're thinking about an exit or starting a business where you'd consider an exit or looking at your next round of raise, you really should be thinking about QSBS. And so with me, like, I do a lot of consulting with this. And so if this is something that would be, interested in talking about, feel free to reach out. And yeah, if you've got any questions, feel free to link those in the comments below and we can go ahead and chat through those. But otherwise, if you want to book a call to have a direct consult, feel free to visit my site, sealycpa.com, book a call, and I look forward to chatting with you there as well. Like and subscribe, put the comments down below, and we'll engage there. So, all right, see you next time. Take care, friends. Bye.